This video on Berkshire Hathaway was taken in November 2019, but it isn't outdated. It gives you a lot of insights about Berkshire Hathaway, the leading personalities including Warren Buffett, and it also shows you the culture of the company. So enjoy!
Hello YouTube, welcome to the second part of our video with
Gregory Warren of Morningstar.
And today we talked about economic moats, Berkshire Hathaway, and my participation on the company's annual panel.
So if you like it, subscribe and leave a comment. Thank you! Hello Gregory, welcome back to the second part of our interview. This time we want to cover Berkshire and learn more about your coverage of the company and your insights. Let me start with the question, how did you get the honor to ask questions for Warren and Charlie during the annual meeting?
That's kind of a funny story because I think it was 2012 when they first rolled out the analyst to be on the panel. And when they came out, they grabbed 3 sell-side analysts, and they didn't pick us up because at that point we weren't reporting but annual numbers, EPS numbers. So we didn't pop on the radar, but we had a relationship and we knew the folks in the Berkshire offices. So we did reach out at that point, like, hey, what happened? Did we fall out of favor or something? And the response was, oh, we forgot. We'll put you in the mix. So basically, I was in the mix. And I was expecting to sort of be, one of the analysts the next year. And then the next year they changed the format and they brought in Jonathan Brandt, who's, I would call sort of a designated buy-side analyst. They had one of the insurance analysts, and then they brought in Doug Cass, who was this, supposed bear. And the interesting thing was that we got bumped sort of to the end of the line. So at that point, I wasn't expected to be on the panel really until 2016. And the issue was, Doug Cass's performance was not viewed favorably by a lot of shareholders. So the next year, they started the process and they were looking for another bear. And it got to be April, and I was, kid you not, literally packing up the car because my wife and I were going to Vietnam for 2 weeks, and I get pinged on my email saying, Berkshire wants to know if you'd be willing to be on the analyst panel this year. And at this point, it was end of March. And I was like, well, absolutely. And I turned to my wife and I says, you're going to hate me. I'm going to have to get the laptop and take it with me because I have to work on questions for the Berkshire meeting. So that was how we ended up on the panel. But I mean, I think the thing was I looked at it as a opportunity for us as Morningstar with independent research. So we have a sell-side analyst, a buy-side analyst. And then I thought we could carve out a seat for an independent analyst to really sort of come to the table. And, I did a good enough job the first year where they asked me back. And I think the thing is I look at it from the perspective of, it's a job. And I have to do a good job at it, and I come to the table every year trying to bring better and better questions. Trying to, because, Warren's only ever told us, look, they want to talk about the business. The reason they brought in the journalists and the analysts in the first place is because they wanted to get more discussion going about the business itself, being able to talk about the operating companies, being able to talk about how they think about capital allocation within the company. So Jonathan and I have basically been designated with the task of talking about everything non-insurance, because the sell-side analyst that comes is generally an insurance analyst or an insurance-specific analyst. So now it's been 6 years I've been doing it. It's a great honor. I mean, I think it's fantastic that they keep asking me back, but I also think that shows that I'm putting in the work, taking it seriously and trying to come to the table with difficult questions for them every year, and really sort of not just make it a show, but also I come to the table trying to get information. Because Berkshire, amongst all the publicly traded companies, is probably one of the most closed in. It's very difficult to get any sort of face time or any sort of time with management overall. In fact, they discourage that. So I think from that perspective, it is sort of one of those areas where we do sort of get to ask more direct questions.
You said that Berkshire is pretty closed about giving publicly information if they don't have to.
Yep.
So it maybe makes it hard to value the company Berkshire. So what would be your tips or your guide how investors should approach the valuation of a business?
Well, I think it makes it difficult in a lot of ways. I mean, it makes it difficult the meeting because I found that I have to. It's different than a lot of other meetings I go to. If a normal meeting with a CEO or a CFO, I can interrupt, I can follow up questions, we can take things in different directions. So it's more like a conversation. With that annual meeting, it's I ask the question and it's out there, and I kind of have to live with where it goes and where the answers go. And I've learned over time that it's about cutting off avenues of escape for Warren, because if Warren can avoid answering a question directly, he will. And I think part of that is also because of he's always cognizant of how he might impact the markets or securities, and that's why I always tell clients it's sort of a fool's errand for me to ask a question about a specific stock, because he's not going to say something that's either talking it up or talking it down. So it's better to frame it in an industry sort of perspective and look at it from that way if you really want to get an answer out of him. Now, as far as covering the firm, we take a slightly different approach than some firms. We do a sum of the parts. We strip it down. We strip everything that's not insurance related out of the financial statements. The energy business and the railroad business, we can run through our DCF model and valuation. And on those businesses, I work closely with the railroad analysts. I also work closely with the energy analysts to try to make sure that not only do our projections make sense for Berkshire, but they're in line with how they're thinking about the industry overall. So, we've got that advantage there. And then on the insurance business, I'm running the investment portfolio and then the insurance operations through there. My work on the asset manager sort of helps me sort of, figure out what, expected returns are going to be for the investment portfolio over time. And then, the MSR is probably the most difficult part of the business. That's the manufacturing, service, and retailing operations. To say that Berkshire is opaque is, I think it under sort of scores it. I mean, for the most part, if they can get away with not disclosing information, they will. And I think, in some respects, that's to sort of protect the businesses themselves. I mean, we have as much information as we do about Burlington Northern and the energy business because they have to file 10Ks and 10Qs. So, that's a little bit more transparent. But overall, there is enough there. And if you do a good enough diligent job of forecasting out those businesses and you're conservative. I mean, that's the way we look at it too. Is we because we're stripping it apart, we tend to be more prudent, more conservative with our forecasts and how we're thinking about different things. I mean, one of the things like on the insurance side, we always build in a year mid-cycle where we have super cat losses. Whenever we're looking at expectations and triangulating outcomes, for fair value estimates for different parts of the business with the rest of our coverage, like a company like Berkshire Energy, they should trade at premium to a lot of the utilities because they are in a unique competitive position being under the umbrella. They don't have to pay out a dividend. They can spend a lot more on CapEx. They can do a lot of things that a lot of their peers can't do. So we're trying to make sure that all those things sort of make sense and that they work.
Yeah, in the insurance business, one main question which always come up is the float of a business. How do you approach this specific value question of Berkshire? How to value the increasing float, which is some people say it's like like cost with where you get money.
Yeah, I think Buffett's created a side business in float. It's an area where we don't necessarily agree completely with sort of how it's portrayed. Float is still a liability at the end of the day. It's the money you take in, to pay out for claims, and for, and basically at the end of the day, what you end up with on a profit basis there is whatever your combined ratio is plus whatever you earn on that capital as long as you have it. So if you have a short tail business like Geico, that's a 6-month to 1 year business. So your ability to earn excess returns on that is very limited. The key to success there is just being a better underwriter overall. And Geico's traditionally been pretty good. I mean, their combined ratio's typically been 94 to 95%. So if we talk, normal terms, that's like a 5 or 6% operating margin. It doesn't seem like much, but basically that's free money on top of other people's money. So I mean, overall, it's a good business as long as you're running it well. But I think that's just the thing. It's like I try not to take float and try to use it to value the firm, because I think that that's kind of the wrong way to look at it. Our DCF model for the insurance side does a pretty good job of sort of, incorporating all of that into it, and we're much more focused on underwriting profitability over an extended period of time, plus whatever gains we expect to come from the investment portfolio overall.
How would you describe the culture at Berkshire, besides the things you already told us?
Yeah, I mean, it's a unique culture overall, and you sort of see it. I mean, because I go to the annual meeting, but also because I go to the brunch the day after, I get a chance to meet a lot of different business heads, and it seems more like a family. Everybody's kind of like-minded, and I don't mean in a Stepford Wives kind of way. I mean more like, they understand and appreciate the value of how they exist, operating it under an umbrella with Berkshire where they can do a lot of the right things for the businesses for the long run. And some of the guys that have been, heads of the publicly traded firms that have been acquired over the years have told me outright they love, working under Berkshire, because they can make tough decisions, even if it means impacting short-term profitability, because it's the right thing to do for the business in the long run. They have access to tons of capital at relatively low rates if they wanted to do deals, to do transactions, to make investment improvements and everything else. And I just feel like there's, even though there's not a whole lot of synergies across the spectrum, it seems to work. When we look at the history of conglomerates, I think Berkshire is the only one that has survived, and thrived over the years, because it's been run on a completely decentralized business. Buffett's not concerned with what the managers are doing on their businesses from a day-to-day business. His primary concern is how much capital is coming up through the system and what opportunities they have to put it to work. He's letting those managers run their businesses, like it's theirs, and holding them accountable when things aren't good. So I think from that perspective, it's a model that has worked. And I think whenever we think about Berkshire for the long run, I always tell people that, yeah, Buffett's important, but the model and the culture is just as important, and it needs to survive him. And we think that over the long run, it's probably going to do fine, as long as the next management team doesn't go in and do anything to sort of disrupt that, or nitpick on every different decision, or micromanage the different managers through the system. That said, we also think that there has been potentially at times a need for some of that. Charlie's always famous for saying it's decentralized to the point of abdication, and it's that's good, but we've seen some examples the past few years where perhaps having a little bit more oversight, or at least like publicly traded firms like Progressive or the railroads have analysts out there with Progressive and Allstate and Travelers saying, what are you doing with telematics? And how is this changing your business? And there's just not as much pressure on Geico. There'll be questioned every so often, but just hasn't been the same sort of pressure on them to adopt the technology and work in their system. And we're seeing the same sort of thing with precision railroading scheduling, on the railroad side. Basically at this point, almost all the North American railroads have adopted in one form or another, and Berkshire's still a lone holdout. So it's those kind of situations where you look at it and say, okay, these huge advantages that come from operating under the umbrella, but every so often there come these issues where you wish they were just a little bit more forceful with sort of pushing the businesses along. But again, that's not Buffett's style, so I don't think it's going to happen, during his tenure. But with the next management team, I'm not so sure that's going to be the case. I think there will have to be changes. There have to be some changes in reporting structures and how they sort of assess the businesses over the long run.
What happens with the cash at Berkshire, and how much is really deposable?
Well, at this point, he's sitting on 128 billion at the end of September. There's 20 billion that he's always said is backstop for the insurance business. I don't think that's a joke. I mean, that really is there because Berkshire has a lot more equities on the portfolio, and having that extra cash, improves the liquidity, for the holdings that are dedicated to the insurance business, but also, placates the regulators to some extent, allows them to carry a bit more equities than not. But if you look at it too from the perspective about upfront CapEx spending and then probably about 2% of revenue held back for just operating cash needs, that 128 billion is probably somewhere closer to 100 billion in what we consider to be dry powder, money they can spend on acquisitions, stock investments, share repurchases, or a dividend if they were interested in doing that. So there's $100 billion basically in cash that's sitting there ready to be deployed.
What would be a target for that, if you could guess?
I think it's harder right now just because of where the market valuations are. I know Berkshire's historically been interested in acquiring more utilities and transmission assets. When I talk to our utilities guys about this, the general consensus is in the industry is if you go out 15, 20 years from now in North America, there'll probably only be 5 large utilities, and Berkshire will likely be one of them. The problem with utilities is they're so expensive right now. I mean, because of historically low interest rates, people have poured into utilities and other, income generating equities to get the yield. And right now, most of our utility coverage is trading about 120% of our fair values, and it's about a 25 times earnings. And it's harder to justify a deal where you're getting probably a 9 to 11% allowable return, from the regulators for the business by paying 25 times earnings. It's hard from a valuation perspective to really justify that. I think as far as other companies they'd be looking to buy, I think there's a lot of Modi industrials type firms that I think would be on their shopping list, and I think that the issue right now too is, from a pricing perspective, those are also at elevated multiples here. We've had quite a few firms, being shifted to sort of wider moats over the past 6 months to a year, within our coverage, and just looking at sort of how much they've improved post-financial crisis. They're much leaner, much better operations, than they ever have been historically. And I think that they fit the profile of what I think Buffett's looking for. He doesn't mind buying capital-intensive businesses because that helps, get some cash off the books, but he likes companies that are in good competitive positions. And I think it's getting harder and harder to find companies where that is truly the case. Retail is having a tough time, with Amazon. On the packaged goods side of the business, we're going through sort of this, not necessarily brand crisis, but a period where brands may not have sort of the same power they have had historically. And then there's other parts of the business they probably wouldn't really shop. I couldn't see Buffett going out and buying a technology firm tomorrow because it's not a business they understand, and it's more of a business that's built on creative destruction as opposed to a long-term sort of sustainable business.
Yeah, if you look at the value at Berkshire, maybe it would be an idea for Berkshire to just buy it itself, share repurchases. That
would be the best use of capital right now. In fact, when we sort of look at the buckets and we sort of look at what the cash is, Buffett said a few years ago that he couldn't have cash on the balance sheet at $150 billion and come back to shareholders and justify it. And the problem for him right now is we're very close to that, and the company's generating about $20 billion in free cash flow. So next 2 years, we're probably going to hit that level if he doesn't go out and work some of that capital down. But so far, share repurchases have been minimal. I've been underwhelmed by the level of share repurchases since they modified the program in the third quarter of last year. We look at it from the perspective they could buy back $1 billion to $2.5 billion a quarter in stock, and it really wouldn't it really wouldn't diminish anything, because you add that up, and that's probably equivalent to what they're getting from Burlington Northern every year as a cash dividend. So they can afford to do that. Our run rate over the next 5 years is 10 to 15 billion on an annualized basis, but that's because we have a $25 billion share repurchase built into the mid part of the cycle, and that's basically sort of a stopgap, for our valuation, because we look at it from the perspective of they get to that point and they're going to have to do something, and if they haven't acquired anything or haven't made big stock investments, there really aren't too many other options available. But the interesting thing too is I was looking through the Q again the other night, and it looked like they probably netted out on stock purchases during the third quarter about 10 billion. So they put another 10 billion to work, and still the cash balance went up 6 billion. So that just tells you, it's the scale of things, and it gets harder and harder and harder for them to sort of whittle down that cash if they don't have the opportunities. And I think that's been the story of the past 10 years. The opportunities for Berkshire have been few and far between. The competition for assets has also been much more difficult. And then, sort of the traditional area where they could put money work in the stock market, it's been harder and harder to find value or good quality names that they can get at a reasonable price. And I think they've kind of limited themselves too, because they're not willing now to own more than 10% of any company's stock. And when you look at the universe of potential stocks, that narrows it down significantly, because they got to own these mega cap firms. And the problem with mega cap firms is, they're not always growth companies. And in some cases they're diminishing companies. So I think from that perspective, I think it's that opportunity set has gotten smaller overall. And to your point, to me, the logical conclusion is buy back your own stock. And when we look at it on a fair value basis, when we put out our report on the company in mid-August, where we talked about 5 reasons to investors should be looking to buy Berkshire, the valuation was about a 20-25% discount to our fair value. Right now it's about 15. So it's had a nice run, but it's still attractive in our book, relative to book value. And I think probably by the end of the year it's going to be about 1.3 times book, overall.
Which part of Berkshire's businesses should get more attention because of the quality they have, and which part of the businesses might be disrupted in the coming years?
Yeah, it's hard because a lot of the publicly traded firms that they've acquired, plus the insurance business, account for so much more of the valuation and so much more of the pre-tax earnings and the contribution to overall valuation. There's a lot of smaller companies out there within Berkshire that if they went away, you wouldn't really notice, because there's much smaller players, so they don't get the level of attention. Jonathan Brandt, who's on the panel with me, is really good about finding nuggets about a lot of these smaller businesses and sort of approaching them and bringing them up at the meeting. But I still think like Burlington Northern, is unsung. We still look at railroads as being very wide moat businesses. They need to do some things operationally to sort of improve things, but I think it's still an important business. I don't think Berkshire Energy gets as much credit for what they've done and sort of the strength of the moat that they have and the positioning that they have. And then the insurance side. Everybody talks about Geico, everybody talks about the reinsurance business, but the most profitable, fastest growing piece of Berkshire's insurance business has been the primary group, which is a hodgepodge of a lot of different collected businesses. But for a while there, they were running combined ratios in the upper 80s, which is unheard of, for the industry. And they've just done a much better job with underwriting, historically. And when I look at that business, going longer term, reinsurance is probably not going to be a higher growth business from a earned premium basis. And the thing they need to do with that business is probably just run it at 100% combined ratio, because pricing is so difficult in that market. But it gives me encouragement to see the 2 faster growing businesses are Geico and the primary group, where margins in profitability are much better than what they're getting from the reinsurance. The reinsurance is still an attractive business, because again, back to your comments about float, you get long-term contracts and you get the capital for a longer frame of time, so that allows you a longer duration in order to sort of generate outsized returns. With that business, though, you're still looking at probably break even, on a underwriting profitability perspective. So, the real gain from that business is getting the returns.
What's the rationale behind the investment in Apple and Amazon?
I think it's a changing opportunity set within Berkshire. I think having Ted and Todd, Ted Weschler and Todd Combs, overseeing the investment portfolio and helping these guys out, I think has been important and has been additive. I don't think they would have bought Apple, had those guys not been around. And I think the thing is, Buffett's even said this. They were willing to put more money into Apple because Ted convinced Warren that Apple was a consumer products firm. He's like, stop thinking about it as a hardware firm. Think about it as a retailer and a consumer products firm. And look at sort of the base of clients that they have and the stickiness of the customer base. And I think that allowed Buffett to look past the technology aspect. Now, that said, technology is disruptive. And there's nothing saying that Apple's going to be the same company 10 years from now as it has been the last 10 years. So, that's why we still have a narrow moat rating on it as opposed to a wide moat. We think it's a great company. We think they've done a great job, but technology is just that way. And Amazon is just another one where, they've probably been in it a lot sooner, if they'd sort of been cognizant of sort of the disruption that they were creating. Same thing with Google. Buffett's always said about Google that, we knew what they were doing with ads and we knew what they were doing with pricing, and we should have put two and two together and figured it out sooner. But again, there's been an aversion on their part to sort of go down that path with technology because, again, it's more complicated and it's more difficult to understand the sustainability of sort of the advantages. And I think that, when it gets put in terms that they can sort of get behind, I think that's when they're willing to sort of pull the trigger and step in. And I think that's what's happened with Amazon.
Yeah, you already mentioned the great culture at Berkshire. The question which always comes up is, who will be the successor of Warren Buffett? How will the management be in future? Will it be very similar, or do you expect bigger changes?
Yeah, it's interesting. There's always sort of the horse race, to see who's potentially going to be the next CEO, and it's changed hands a few times since I've been covering the firm. But yeah, I think at this point, they sort of signal by making Greg head of all the non-insurance businesses and Ajit head of the insurance business, who their sort of two preferred candidates would be to take the helm. And I think Warren would love to have Ajit take the helm. I like Ajit. I think he's fantastic. I think he's done a great job with the insurance business. I think the changes that have taken place at Gen Re and the changes we're starting to see at Geico since he took over have been additive overall, to the insurance operations at Berkshire. But I don't think Ajit wants the job, and in plain terms, he just doesn't want to be in that same sort of spotlight, which is fine. I would prefer he stayed and oversaw the insurance operations because it's something that he loves doing. It's something he has a passion about. So from that perspective, I think that's a good thing. But still have him available to advise, the next CEO. And, we still think that Greg Abel is probably the most likely candidate to sort of fill that role. He's a little bit more of an alpha personality, a little bit different than sort of Buffett. But he's also done a lot of deals over the past 20 years. He's done straight acquisitions. He's done acquisitions out of bankruptcy. He's been involved in heavy capital spending, within the utility sector. So he's the kind of guy that is used to sort of thinking about capital allocation and where are we going to get the best return over the long run. And as long as he's got Todd and Ted working closely with him, I think they'll do a good job. But I think that sort of tells you the dynamics that, it sort of takes three guys to do the job of what it was one guy, previously. But again, I think the business has changed. And I think during the time I've covered it, and the 10 years before that, when I did own it and did keep track of it, it's sort of that state where it's evolving. It's becoming a much more mature company, and I think the days of Berkshire going out and doing a ton of deals are probably behind it. I think they'll still be opportunistic acquirers, especially on bolt-on deals that help improve different parts of the business. But I think, going back to our point earlier, I think there's certain aspects of the business, like the reporting structure and things that we take for granted with most companies, that I think still need to be sort of solidified within Berkshire. Buffett's been unique in how he's run the business historically, and I'm not sure the next guy can do it the same way. So I think there has to be more collaboration. And I think that the biggest risk for the firm going forward is that culture, is maintaining that culture and, improving some aspects of the business, putting some restraints in, but at the same time not spooking the managers that are running the businesses down the line who are accustomed to doing things a certain way. So I think from that perspective, that's really going to be the biggest challenge. That and keeping shareholders on board with what they're doing.
Let's go back for the end of our interview to the annual meeting with two questions. How do you generate your ideas? And what's your guess? Will we see Warren and Charlie again alone on the stage, or will it change next year?
Yeah, I think there's been more clamoring to your second question. There's been more of a clamor to have Ajit and Greg answering more questions and participating more. I mean, I think people would love to see Ted and Todd up there too. I think Ted and Todd would be a little bit more difficult though, because again, the setup of the meeting and how things are staged, I think it's harder to ask questions about direct stock investments. And I think that's sort of where Ted and Todd are a little bit more involved. So you're not going to get the kind of answers you'd want to, maybe you'd get in a one-on-one sort of interview. But as far as the idea generation from the meeting, it is interesting because I remember that first year when I was going to the panel, I sat down, I came to the table with more than 50 questions. It's because first I didn't realize I only had 6 during the course of the meeting. And second, I was under the expectation I'm going to lose questions along the way. And I probably checked off 30 of those questions. When we went through that. And I'm like, well, I have to be better about my process. So the next year I came to the table and did a much more thorough job. I think I had about 35 questions that second year. And, I started to lean more towards asking more direct questions on the railroad and the utilities business because we get a lot of good research coming up through our group that highlights a lot of the different things we're saying. And again, if my role at the meeting is to give Warren and Charlie an opportunity to talk about the business, or to get Greg, well, Ajit's a little more difficult because, Jonathan and I aren't necessarily allowed to ask insurance-related questions. But, getting Greg to sort of answer questions, or Matt Rose from the railroad, trying to sort of drive questions that, either, Warren was more comfortable deferring to them, that they give more detailed answers, or where, he and Charlie were fine, sort of addressing the question at hand. But a little bit of mix of that, and then more of a focus on how are you thinking about capital, how are you thinking about capital allocation, how are you thinking about succession and the longer term run of the business. And I think the most interesting that's happened over time is Jonathan Brandt and I, who are sort of fishing in the same sea, have sort of stayed out of each other's lanes. He tends to focus a lot more on the MSR, the manufacturing, servicing, retailing businesses. I tend to focus more on the utilities and energy. We both sort of get into capital allocation, but it's funny because I've noticed over the past several years, we've stolen questions from each other on a far fewer, basis. I mean, that's kind of the challenge is, you're going to go to the meeting, you're going to lose questions, and the real strategy is to avoid the obvious questions. So like the hot topic issue going to the meeting, it's usually going to come up from the shareholders or the journalists. So unless you have an opportunity to maybe follow up on a question or an answer they've given, it's generally not worth, even writing the question out. I mean, you can put the topic off to the side, but yeah, I try to delve in more into areas where I think I can get them an opportunity to talk more in depth. And again, for me as an analyst, give me more insight into how I should be thinking about the profitability of this business, or I should be thinking about the volume growth, or where things are likely to go over time. So it's an interesting process overall. And again, like I was saying earlier, when you think about asking questions at the meeting, it's more art than science. I sit there and go through my questions over and over and over again. In fact, that day before the meeting, I generally lock myself up in the hotel room, and that's all I'm doing is I'm cleaning up questions. does this work right? Am I taking too much time? Am I getting to the crux of the question? Or, the other point is, am I cutting off enough avenues of escape where I'm going to actually get a good answer as opposed to, a more generalized, broader answer that doesn't really get to the heart of the matter?
Do you have something to add for the end of the interview?
No, I'm good.
Then thank you very much.
Do you have anything else you'd like me to add?